In the near term, what's so important to you that you just wish you could tell everyone that? And then in the long term, what's your outlook for all this?
Yeah, I think it'll get better. My near-term thing is we're in tax season, so just file.
Please file your taxes.
It'll be okay. File your taxes. I promise. Like, even if it got slightly wrong, the IRS is not going to like haul you away in handcuffs or something. Just file. Do the best you can, only because it's a good look for the industry. Longer-term outlook.
Today's guest is Miles Fuller. He's a Senior Director of Government Solutions at TaxBit. Miles was also previously the Senior Counsel at the IRS and worked there for 15 years. And then prior to that, he was also a Special Assistant at the U.S. Attorney's Office. We're in the heart of tax season, and I'm excited to talk to Miles today about that, his outlook on the industry, taxing, closing the gap, and everything else. Miles, welcome to the show.
Yeah, thanks for having me. I'm excited to talk about tax. This is the tax time of year. And every year there's plenty to discuss around crypto and taxation.
Yes, and we're going to make it fun. It's not boring to talk about taxes.
Yes, we can do that. We can certainly try, and hopefully people enjoy it.
To start off, Miles, can you tell us a little bit about yourself? I mentioned you in the intro, but how did you go from these government agencies to TaxBit?
Yeah. So as you mentioned in the intro, I spent 15 years as a lawyer for the Internal Revenue Service, or a little over 15 years. And there's generally two flavors of lawyers there. There's sort of the people in Washington, D.C., they write guidance and policy stuff. And then there's the other type are out in the field, so to speak, doing litigation, advising on cases. I was the latter and spent a lot of time working on cases, advising revenue agents. Those are auditors for most laypersons. Mm-hmm. And so through that is when the IRS in the field made a decision like, hey, we need to figure out this crypto stuff. And this was probably 2016, 2017 on the civil side of the IRS, the not criminal part. And I had a little bit of knowledge around it. So I got anointed as the lawyer to kind of help them figure that out. And that came with lots of unanswered legal questions, lots of unanswered questions around just how do you examine this stuff? What does the data mean? How do you get data from places? So there was a lot of learnings there, and it's been quite an adventure. Trying to figure it all out. And that led me, piece of that to get to the TaxBit part was figuring out how to work with the data and how to do sort of crunch the numbers, so to speak, from a tax standpoint. It was very clear that using things like Microsoft Excel or spreadsheet stuff that normally examiners use wasn't going to work for this or be very, very slow. So they looked for a proprietary software. And then TaxBit was a company that was able to win a government contract to do that. And from there, I kind of became friends with the founders of the company, and they asked if I wanted to help grow the business in this particular space. And so I took the opportunity to jump and try something new.
Amazing. And how's it been? It's been 3 years, right?
It's been exciting and crazy. And it's definitely a little bit out of my wheelhouse every day. Every time I think I understand something, I realize I don't really understand it. Or there's some new novel like issue to it or something. So it's super interesting, and it's a lot of fun at the same time.
Yeah, we'll definitely get into TaxBit in a minute, but you mentioned that while you were at the IRS, they got into it back in 2016. And by got into it, I guess it means like started thinking about how do we tax this thing. And that's like 9 years ago at this point, give or take. And that is a lot older than a lot of the cryptocurrencies out there. So obviously their stance probably changed over the years and things got more sophisticated, et cetera. But while you were there, how did the IRS look at digital assets, and how has that kind of evolved from maybe those early days to when you left?
Yes, it certainly evolved quite a bit. However, the fundamental premise, which in the tax code, and there are really no specific provisions dealing with crypto assets in the tax code, although we'll probably touch on a little later, except for some reporting ones, but substantive tax rules, there's not. So the IRS started all the way back in 2014, they issued an original notice that basically said, hey, this crypto stuff, cryptocurrency, digital assets, what we call it today, virtual currency, they called it for a while, it's just property. But it's not the same, not necessarily the same type of property as securities or commodities or anything else, but property in a general sense, because it has value, it can be traded and all this stuff. And so the typical rules for property are what applies to crypto to this day. However, where the IRS has tried to go down the rabbit hole and has evolved is the complexity of the type of transactions people can do. It's very easy to say, hey, I bought some Bitcoin, I sold some Bitcoin against US dollars. Then it became, I'm buying Bitcoin, but I'm trading it for ETH. And that's a pretty straightforward, sort of swap or spot trade. But then you move into DeFi and talk about liquidity pools, wrapping, unwrapping, interoperability between networks, bridges, lending pools. Everything starts exploding. The IRS is still getting its head around to this day. Like, what is the economics of what's happening? And then how do we like look at that in a tax lens.
Yeah. It reminds me kind of like there's like a meme out there where it's like someone who made like $1,000, but it's like a laundry list of like the ways they got to that $1,000 through crypto. And it's like, I traded this for that. And then I bought this. And it's like, you lost me. You lost me after
Yeah.
like the first trade, essentially. But I'm sure on their side, they're not lost. But that's really interesting you bring that up too, because I'm thinking about how it's not just digital assets, right? It's like also these other I don't know how you want to frame it. I'm thinking of like NFTs, but then also like these liquidity pools and other aspects that contribute to possibly getting taxed, right? So they have to think
Yeah.
about all of these things.
It's weird because from a tech level, it's very sophisticated. And we started at some point very early on when I was there in the IRS was trying to get in this and understand the technology, understand how to audit it. We had a few really, really smart people. We had a couple people that were very deep in the cryptography space that were kind of technical advisors to try to teach lay people like myself. I'm not a coder by any means to understand it. But one thing we came back to is like, hey, whatever you call it, whatever the asset might be, it's still kind of property. So if you just follow that premise, and if it has value, you buy it, you sell it. But then identifying those different things and tracking those becomes an issue. And so you're right. You started with like fungible tokens, so things like Bitcoin, ETH, and then you move to like non-fungible tokens, and then you have sort of special purpose tokens, which I think of like liquidity pool tokens, which are in some iterations might be a fungible token depending on which version of a protocol you're dealing with, and then in more recent iterations they might actually be an NFT. And so how are you tracking those and tracking values? And then there's questions of, hey, when I put this stuff in a protocol to provide liquidity, is that a taxable disposal of the units I'm putting in the protocol? And then do I now like have value in my liquidity token that I got? That's really just a claim against the protocol. It's not like a token unto itself, although sometimes it is. It can be traded around the ecosystem as well. So these are fascinating tax questions that arise from very fascinating economic questions of like how we transfer and move value around this ecosystem. And we can do it at massive scale and volume because of the ease with which we can move things digitally, as opposed to traditional finance, where you have to call somebody and it's very slow and clunky.
Right. Does TaxBit look at this differently than your time at the IRS? Because obviously you guys are not, well, maybe not obviously, but you're not, the government agency, but you mentioned that you do work with them. So how do you kind of approach the situation?
So TaxBit as a company did start as a retail investor or individual taxpayer kind of tool to help you prepare taxes. After a few years, we exited that line of business and we really focused on the enterprise level. So one of the things we can get into is the one area where there's digital assets is in the tax code, relates to reporting. So it's this concept, just like you and I today would probably we get a W-2 from your employer maybe. Right. You probably get a 1099-B from your Charles Schwab or Merrill Lynch, like a brokerage form. That type of broker-related reporting is now going to exist starting this year. Going into next year, you'll get the forms for digital assets. So what we focused on here at TaxBit is enabling enterprises that are in that line of business to be able to do that reporting and give their customers adequate tax information so they can make tax filing easier. We do that for tax. We also do financial reporting. And then, as you mentioned, we do support the government. And all of this is largely from a data processing kind of standpoint. Like we support the government if they are, to this day, like the IRS, if they were doing a tax audit and they have all this data from various custodial exchanges and on-chain wallets, all for a particular taxpayer, and they need to bring it all together and crunch kind of the numbers to get some sense of what's the tax impact. We can help them bring all that data together to look at it and be able to let the IRS investigators see like, oh, maybe we're missing some information here, or this is what's going on, or ask good questions of the individual involved and try to find the right tax answer to see if the taxes were adequately reported or if they were underreported or maybe even occasionally overreported.
In regards to what you mentioned in the beginning, you said there will be for the form 1099, correct? There will be one going for next year. So not for filing for this year, but for 2026, when we're in 2026, filing for 2025.
That's 100% correct. So very similar to what you historically experienced if you had a normal brokerage account. You bought and sold Microsoft stock, say, with Merrill Lynch. They would give you a 1099B form that says, hey, these are the stocks you bought. These are what you sold them at. Here's your taxable gain. We're going to start seeing that, correct, for this year, 2025, the custodial crypto brokers, so the ones that you have accounts at as opposed to your on-chain stuff. They are collecting information this year. So at the beginning of 2026, you will get a similar form. It's going to be called a 1099 DA. The DA is for digital asset. And it's going to tell you, here's the crypto units that you sold of the various assets and how many units. And then the first year, just for next year, it's only going to tell you the proceeds side. So how much money you made off the sales. They have another year after that to implement the acquisition like cost side, the purchase side. But eventually in about 2 years, you'll start getting information that says, hey, you bought and sold like Bitcoin on this exchange at these prices, and it'll make tax filing much, much simpler for individuals.
Yeah, I think it's been a nightmare historically. I
Yes.
always do not look forward to doing my taxes. So this is for like the Krakens, the Coinbases, et cetera, of the world. They'll start to roll this out.
Correct. It's going to cover all of those. Think of like custodial exchange. The other area that it covers that's a little bit novel are certain payment processor entities. So if you're using that, your crypto to buy your cup of coffee or whatever, and right now you would know if you went in to make a purchase with a credit card, there's some point of sale system there, some processor. In the crypto space, there are those services like BitPay might be an example, PayPal or Venmo operates something similar. In some situations, that payment processor will also be responsible of like giving you information when you disposed of that crypto of what your cost basis was and what the price was that used to make your purchase. So that'll be another, in addition to your Krakens and Coinbases, you'd have that area as well.
What about the crypto wallets, like the Phantoms, the MetaMasks of the world, the Rainbows, all those different ones? Like, how does this play into taxes?
So for the moment, like from a individual tax reporting standpoint, I, as the individual who's doing that, am responsible to report all of my taxable transactions I'm conducting with those wallets. So just because, and this is one of the great, I want to say like misunderstandings and sometimes sort of stick your head in the sand things for some people where they're like, well, maybe the government won't really know about the stuff I did on chain. They're just worried about what I did with the custodial brokers of the world. And that's not like from a tax standpoint, it's all taxable, regardless of where you did the activity. However, as you point out, like there is a tremendous amount of difficulty when you start to be on chain. One of those difficulties is even just getting the data. When you're doing basic stuff on chain, like on-chain swaps, that's not too hard because generally the on-chain data will surface to you like, hey, I swapped ETH for USDT. And you can see that in the data and you're able to do that, put that in some sort of tool. When you start to get into decentralized finance with various protocols, you don't always see what's happening economically inside those protocols. So that can make it really, really hard for a user to have adequate tax data. To be able to file their taxes correctly. And the government, so as you bring this up, on this point of this reporting, this 1099 reporting, at the end of last year, the IRS, the Treasury Department, released a final rule that was attempting to impose broker type, 1099 type reporting on certain decentralized I'm going to say, I don't want to say decentralized protocols because it actually explicitly was not intended to apply to the protocols themselves. But rather to certain intermediary, I'm going to say intermediary, that's maybe not the best word, but basically certain things that the government defined as a front-end trading service, which if you think about it, I could give you the definition of that. It's kind of a very wonky, like, what does this mean? Really what it boils down to is websites. Like if there's a protocol operating on chain at a smart, at an address, there's a series of smart contracts that are conducting the trades. They're like the engine. However, generally accessing those for most everyday people, you need to access those via some sort of UI, some website. And so the idea there is while the protocol, and this is the idea, the approach that the Treasury Department was taking, was that while the protocol itself might be autonomous and unalterable, and there's no real person at the protocol, however, the belief is generally that the website is being operated by real people who could implement some reporting, some sort of broker type reporting on the sales. So that's where the Treasury Department landed. Right at the end of the year, it was late December that those came out. However, those rules, there's a number of people in the industry that disagree with those rules and disagree with just fundamentally the concept whether or not decentralized like protocol activity should be subject to broker reporting. And There's currently a lawsuit challenging the final rule. It's in court down in Texas, and so it's a lawsuit. It hasn't gone anywhere in the past 2 months, like because most
Like many
lawsuits do.
lawsuits, yeah.
Yeah, it did move very, very slow. However, on a different path, there's a tool that Congress has called the Congressional Review Act, where they could
Mhm.
invalidate any rule, not just like crypto stuff, but any rule that any regulation that's published by an agency. So
Mhm.
this particularly final regulation is currently being reviewed in Congress under the Congressional Review Act. Actually, just at the end of last week, the Senate voted to invalidate the rule. It's through a process known as it's a joint resolution of disapproval. That's the technical term. It's joint because both houses have to vote, like any law. They both have to pass it. So the Senate passed it. It came out of committee in the House, but I'm not sure when it's up for an actual full vote in the House. Probably pretty soon, though. And then it's already been telegraphed that once both houses sign, it would have to go to the president's desk for signature. And it's been indicated already the president would sign it. So it seems likely under this Congressional Review Act that this DeFi broker rule stuff will be pulled back or invalidated.
Mhm.
And we'll see where that leaves the government with trying to figure out how do we get better visibility around what's happening on chain.
Right. What is the argument against it? You mentioned earlier that some people in the crypto space were not happy about it. Why aren't they happy? Because they're like decentralized entities and they don't feel like they should be responsible for it, or something else?
I think there's two avenues of arguments that I've always heard. And first one that I think is the very practical argument is implementing this type of reporting through websites that are tangentially related to decentralized protocols is really hard. You're making people just operate a website, maybe all of a sudden have to collect KYC, tax information about who the users are at that website.
Mhm.
So that could be, from a technical lift or technological lift, very difficult. The other main argument is one that's more of a policy related argument. It's the concept that, hey, decentralized finance is all about peer-to-peer transactions. Broker reporting involves this concept of that there's an intermediary. But peer-to-peer transactions you're doing on chain, there doesn't seem to be any intermediary. Why are you trying to impose reporting here? So that's like, and then some of that also raises in that same vein, like privacy right stuff. Like, we're having all these people collect information around users in conducting activity on the on-chain ecosystem, and that's maybe violates the constitution in some way. So those are the primary arguments they have. It'll be interesting to see how it plays out. The one unfortunate thing from my perspective is that if Congress invalidates the regulations under the Congressional Review Act, we'll never really get a clear answer as to whether or not the law that Congress passed back in 2021 that put all this into place was ever meant to include decentralized finance. That's an answer we would get if the litigation played out, because you have a judge who actually gets to interpret the law and say, hey, this group of people is either in or it's out. And that would be like a final decision on it.
Mhm. Yeah. So I guess we're going to have to wait and see on that front then. How long do you think it'll take? Or we don't know because.
We don't know. And what's interesting is if what'll happen probably procedurally in the lawsuit, if Congress does invalidate the regulation through under the Congressional Review Act, it is likely the lawsuit will just go away because the lawsuit is an APA, it's an Administrative Procedures Act challenge to the regulation. But if the regulation is no longer in existence because it's been invalidated, then the lawsuit's moot. So I could see the lawsuit just going away, which then we'll never get the answer that we probably all would want to get an answer on.
Yeah. I also wanted to talk to you about, I believe it was on New Year's Eve, which is a crazy day to announce something, but the IRS announced a temporary relief through a new crypto notice, or I guess it was new at the time, providing transitional relief to taxpayers. Can you kind of break down what this means and if it has like any relation to what we just talked about, or they're completely separate developments?
It has, yeah, totally. And the notice is like way more. I think there's been a lot more news media around this notice than probably it required. It's kind of, it was a very, for people in the tax that are tax professionals, it was like, oh, this is a pretty straightforward notice. Yeah. It is tangentially related to what we were just talking about, not so much the decentralized finance, but the concept that there is, as we talked a little earlier, custodial broker reporting. And one of the things that came out, so those custodial broker rules were passed, they were finalized June of last year. And one of the things that they required is that individuals now will start at the moment we conduct a sale, we'll need to start deciding like which unit we're selling. So if I have 5 Bitcoin on Coinbase, I need to know like which unit I'm selling. I might have bought them at different times and I need to pick which one.
Right.
Historically, people have done what I call the choose your own adventure of tax, which is they wait till like they're doing their taxes and then they just go back and like retroactively decide like, oh, what would be the optimal tax one to have sold and figure it out. Going forward, you have to start picking that like in real time, either picking for each sale individually or follow some patterned approach, such as first in, first out, highest in unit, first out. So that was a change that came in June. One of the requirements with that was that when I'm selling, I need to tell my broker, so your Coinbases or Krakens or whatever, which one I'm selling. And that rule went into effect as of January 1st this year, that I as a customer had to tell them. However, under the same rule regime, the brokers, so the Krakens, Geminis, Coinbases of the world, they did not need to be ready to receive that information from me as a customer until January of 2026, a whole year later. So you had a disconnect here on timing where they're like, well, how can I tell the broker if they're not ready to do it? So what we got was this notice that's like a 1-year transitional relief notice that basically says, hey, for 2025, since the brokers maybe aren't ready to get that information, you can just basically tell yourself, like make a note in your own records of which ones you sold and it'll be fine. And that's all the notice says. 5 pages, 6 pages, just to say,
so it's on
your own records.
It's on the individual to take notes.
This is on, yes, it would be on the individual.
Seems like a lot of work, Miles.
Yes, it is. But so this is where it's funny. I would say that crypto is no different than any other part of tax filing.
Yeah.
All those years I spent doing tax litigation and stuff. You always think of the classic example of like, yeah, the mom and pop business owner, they show up with a shoebox of receipts and they're like, well, I think it's all in here somewhere. Crypto's no different. People are, they're always waiting. They're not super diligent about keeping records. It's a classic human behavioral problem, and it's not specifically to crypto. It's everybody. We don't, except for maybe nerdy finance people or accounting people that like keep really good records. But most ordinary people are like, hey, I'll figure that out later.
Yeah.
That's how it works.
During tax season, I'll figure it out. Maybe near the deadline. Maybe I'll get ahead this year, but yes.
Yeah, exactly.
What else is being done to help close this tax gap for the crypto community? Are there any other developments that you're monitoring that you think are important to taxpayers or just for the industry as a whole?
I think in general, actually, the question you raise is really good, given we have a new administration with lots of activity. Setting aside, so up until, December 31st last year, the program that I was kind of involved in the early stages of helping the IRS civil compliance program was really being put into place to sort of chase down what we believe is this crypto related tax gap. There's a massive tax gap even without crypto. So like, we don't want to put it all on crypto. And I don't know that there's been some estimates, but I don't think the IRS has ever done a true analysis of what portion could be crypto. But they were making strides in trying to figure out how to, identify the likely non-compliant people, chase them down. And that's what's been in the works for the past 5 or 6 years. And because this is a new space, trying to develop or understand like what behavior patterns or what kind of reporting behavior is likely to lead to tax non-compliance is always a struggle. So the IRS has been trying to get their head around that. You've probably seen the news when I said 2016 is the first year. That was when the IRS initially used a tool they have called a John Doe summons, and they went to the Coinbase exchange and said, hey, Coinbase, turn over a bunch of customer data. Since then, they've used that same tool to go to Circle, to go to Kraken, to get similar information. And they're trying to use that to find non-compliant people, but also to understand behavior patterns better. So they're on their way. Now we're in this new phase with the new administration, and we're hearing a lot about Doge and cuts to the IRS and stuff. Right. So I think there's a little bit of uncertainty of like where the closing the tax gap for crypto is going to be in 6 months, or how the pieces that the IRS has already put into place might get altered. And we'll certainly learn more, hopefully in a few months, if there's a new commissioner that gets confirmed and what the direction is. Right now, everything's a little up in the air in my mind.
Yeah. I also heard rumors of the crypto capital gains tax being removed. I don't know if that's like a reality, or is that just optimism from the space? Remember trying to move your assets between chains, watching the minutes tick by, wondering if your transaction would make it? Yeah, we've all been there. But here's the thing. While other bridges feel like taking the scenic route, Across is your express lane. Base, Arbitrum, Optimism, boom, boom, boom. Your assets move between them faster than you could say cross-chain. Across isn't just another bridge. When Uniswap needed the fastest, most reliable way to move assets cross-chain, they chose Across. Now, millions of Uniswap users are swapping between chains without even thinking about it, because that's how it should be. Whether you're moving assets yourself or building the next big thing in crypto, Across makes cross-chain feel like the same chain. No more scenic routes, no more complexity, just 2-second transfers between chains. Ready to join the Express Lane? Head to across.to and experience what bridging should have been all along.
I've heard the rumors too.
We've seen the rumors,
I even went, because I'm a lawyer at heart, so like going back and finding, kind of a little bit very similar to you as like a journalist, like finding like what was the source of this. And so I tried to dig around for it. I've heard the rumors. I've yet to seen any like positive affirmative steps in the new administration to do this. Yeah. Some people thought late last week with the Washington Crypto Summit, the president's crypto summit on Friday, that we might see that, but it was made very clear by one of the White House officials early in the day. They're like, no, it's not tax stuff. This is more SEC securities stuff. Yeah. So I'll be curious to see what happens. Clearly, President Trump has indicated that the Trump era tax cuts, the TCJA, that was passed in his first administration, those are all up to expire. So there's going to be a massive tax bill this year anyways, even unrelated to crypto. There's been rumors of a few crypto provisions that they would like to be added. These are things like a de minimis exception for not having to pay capital gains when you buy that cup of coffee or something, or possibly lending related, to make clear that like lending crypto units is non-taxable. Some other rules like that. I have not heard of this particular, like just total tax-free crypto as one of those. And even then, the rumor I've heard has always been like tax-free crypto US crypto projects. Ooh, and okay. We're crypto people. Yeah. So crypto's everywhere. Like, how do you that would be very hard, Made I think, America, just practically to implement. Like, what's a US crypto project versus a non-US project? Yeah. So we'll see. The rumors are there, and rumors over time maybe become reality. Yeah. But I have not heard anything formally yet of that moving forward.
Given your existing role, I feel like you're kind of like the resident subject matter expert to government / tax code / IRS relationships, right? What are the most commonly asked questions from both entities that you're getting now?
I think it's on the industry side, it's more around like, what are the rules on how to tax? Like, what's the tax rules for this? And then on the government side, I think it's like, how can we figure out which people are not paying taxes? And I think I always kind of go back, and I'm a little bit like OCD, I think, sometimes on things where it's like, okay, the first, like the tenets I have whenever I talk about this, like in conferences and stuff, is like the first tenet of crypto taxation should be, what are the rules? Like, what are the tax rules? That's the government's responsibility to kind of tell people, like, these are the rules you have to follow, whether it's telling industry players, developers, whatever, or individual taxpayers, most importantly. The second rule is we need to arm the individual taxpayers. Once we know the rules, they need to be armed with the correct tax information or tax data to actually be able to comply. And that's an area where I think doesn't get enough airtime in the discussions. Like, where are the limitations? Clearly, custodial brokers do a decent job of getting their people the right information, but you go to DeFi, I can't see inside the protocol. So outside of trying to like look and screenshot my UI to like track when I earn some reward, I don't see it. I can't like a year later go and pull the history of like what happened inside a smart contract. That poses a problem for me as a taxpayer, that I can't get the right data. And then the last area is like, once we know the rules and once all the taxpayers have the right data, you can really enter this conversation, which is the one that relates to this DeFi broker stuff, is like, how much of that tax information needs to be shared, not only to me as a taxpayer, but also shared to the government as broker reporting. And that's where everyone's like, there's this back and forth about and uncertainty. But I always think of, we should step back and think about, what can we do? I talk to developers sometimes, and it's like, hey, have you ever thought about like, how do we get a tax standard, make it easier for people to get their best tax data so they can actually be compliant first? And that's really what the government would like. They want people just to report accurately out of the gate, and then you never have to hear from them again. Yeah. So those are my like talking points, and they always seem to have slightly different questions on both sides.
Yeah. I'm thinking of, so there's like probably 2 to 3 types of people in crypto. One who is like, I buy something on a centralized exchange, maybe once or twice. Maybe I sell it, or maybe I just hold it. Okay. And then there's the people who do that, plus they might transact occasionally on chain. They might buy a meme coin. They might hold the meme coin. They might sell it. They should probably sell it. Not financial advice, but meme coins don't last long. And then there's the third category of people where it's like, they are fully on chain and they're like day trading 24/7. For the middle and that latter category, how do they like even think or start to think about taxing that? Because if you're constantly making these like little changes and like maybe you like got a gain on one and then a major loss on the other and then a gain on the other, it's like it feels so complicated when it comes to you have to sit down and write it out.
Yeah, no, I think what you described exactly right. I would agree kind of most like with those three buckets.
Mm-hmm.
Obviously, as you kind of point out, like the first bucket, it's a given. Like they
Yeah,
can
like
get their,
they'll
they
help
will
you.
get their
Yeah,
information from the brokers. They'll be great.
exactly.
The middle bucket gets a little more complex. My advice to those people, and really to the third bucket as well, is again, it's back to this like shoebox problem. It's like be a little bit diligent about knowing like where you're doing activity. And don't just kind of run amok and chain hop and go to protocol to protocol. At least
Mm-hmm.
keep some record of like, hey, this is what I did. And these were my addresses I was doing stuff at. Because when the time comes, they do need to file taxes. At least if you have that sort of list, you have a starting point. Now, the middle category, I think they actually are in a spot where we are today with the way the technology is and the way the data is. They are likely in a position to be able to do their taxes just fine, with a little bit of help, either using software that's designed for that type of work or talking to a tax professional. Because if they're just like, hey, I did some stuff at a custodial broker. I did some on-chain stuff, but it was kind of buying and holding, but it was just mostly basic trading, but not complex DeFi activity.
Mm-hmm.
I can get the data for that and figure it out. It's really the third group that has the hardest time, and there's just not a good answer today.
Yeah.
It's like, I know I wanted some liquidity pools, but what did that mean? Was it taxable or not? Or what was the value around that? And
Mm-hmm.
those are really hard. And it goes back to my first sentence, like, well, first the government needs to help give some answers on like, hey, is lending of tokens, is entering or exiting a liquidity pool a taxable event that you need to worry about?
Mm-hmm.
And try to give those answers. And then if we know that those things are taxable, then it will be on the developers or in the community to ensure that they are surfacing to their users the correct data for tax purposes.
Mm-hmm.
And maybe that's what they're waiting for. I don't know. I keep nudging. I think the developers are building just to build because they like to build.
Yeah.
And compliance maybe is the second thing a little further down their mindset. But hopefully that's the discussion I like to have with developers is like, hey, how can we surface good data to your people so they can, your customers, so they can be compliant?
Mm-hmm. Do you see a world where these crypto wallets and on-chain DeFi protocols and all these different categories will start working on providing it or having to provide it the same way that these centralized exchanges do?
It's hard. I think there is a longer term as the ecosystem evolves. And even here, as I mentioned in the United States, this decentralized finance broker rule that's maybe going to get invalidated.
Mm-hmm.
Even though that might happen here, other jurisdictions around the world under the sort of tax standard internationally known as CARF, that's the crypto asset reporting framework, other jurisdictions are working to impose similar tax reporting rules on decentralized finance in some way. So I view that as a little bit of, maybe think of that as a little bit of a stick, right? That's the government saying like, you need to report this stuff. And there's going to be a necessary trickle down piece of like, well, if you start needing reporting this stuff, developers are like, well, we got to figure out how to make it surfaceable to be able to report on it. And that will have an indirect way of like, even outside of reporting the government, the users will get access to that data. But I think there's a conversation there, even as we go into this next step, where maybe these rules here in the US get pulled back and the Treasury Department and Congress will be left with like, well, what do we do to ensure compliance in this area? There's really an olive branch. I think the industry can reach out to say like, hey, like we can try to do what we can to make sure the customers, the individual taxpayers have what they need. And that's going to require a little bit of thoughtful input on how to develop protocols that it can have good data endpoints for tax related data.
Yeah. Okay. If there's one big piece of advice that you can give listeners ahead of this tax season, what would it be? What do they need to know? What's your like, not legal advice, not tax advice, but like, you know what I mean? In the sense where it's like, hey, you really should do X, Y, Z. You got thoughts?
Yeah, my advice I always tell people is like when in doubt, like make sure you file. One of the things you hear in the space that I've heard for a number of years is people, want to file. They maybe know they appreciate that they need to file and report, but they're like, I don't know where to start.
Yeah.
I'm like a deer in the headlights a little bit. And then they choose not to file because they're like, well, what's the worst that could happen? And my point is like, well, it's going to be a lot worse if you don't file than if you try to file. One thing from my time at the IRS, when I was there, and I still see it it still exists today, is they understand that this is a difficult space and accuracy is difficult. So where they see people filing, even if they were to audit somebody and have to make an adjustment to what was reported because it wasn't totally accurate, there's a lot more grace given by the government to the people that are coming in and trying. So I'd always say just file. Now, to actually achieve the filing part, I would say go what I said earlier. Is like try to have like a list or like identify where were you doing activity and then start gathering the data from those places, and know what data you might be missing and what your sort of risks might be. But get the data together and do it, and it'll all be okay. Like just it'll be
What if
fine.
someone messes up?
The what?
What if someone messes up?
Then I think if you filed one,
Will
if
you be
filed and
forgiven?
you tried, the IRS, like they may audit you. They may not audit you
They
because you
may
filed.
audit you. Yeah.
Yeah. And if they do audit you, at least you can say, hey, look, I filed. I was trying to do the best I can. This is the data I had. You know, if you need to make a tax adjustment, but it's less likely that you're the criminal side of the IRS isn't going to likely not going to become knocking. The civil side. Yeah. Yeah. They're looking for people not filing, or they're looking if you like intentionally lied about something is what the criminal side's looking for. So if you're doing your best, I think it's better than not doing anything at all.
I agree. Is there anything about this existing tax season that has changed from the last one that is important to highlight?
Not anything from this tax from last year to this year. There were really no big changes last year in the tax world for crypto, other than there's just more and more tokens every year, as you mentioned earlier. Yeah. I think when you mentioned like when I started, it was like something like 3,000 tokens. You go to CoinMarketCap and it's like tracking three. Now it's like in the millions.
Yeah.
Where these things keep
3,000
anybody
seems
can
like
pop
a
one up.
crazy amount. Yeah, exactly.
But no big substantive changes.
Yeah. Okay, that makes sense. I feel like we talked a lot about like the existing situation or the tax gap, so to speak, which is something I should probably have you define as well. But what are the current digital tax issues in the US that you think still need to be ironed out? Very well done. Like we're at this point, we really need to get to this point. And also, what's the tax gap? We should have said this earlier.
Yeah, so sure. So definitionally, like the tax gap is the difference between, and there's two layers I'll give you, two variations. Truly, it's the difference between the amount of taxes that are actually collected or paid to the IRS versus what should have been paid. If everybody, their tax is 100% right. Okay. Now that collected, that first part though kind of has two slight wrinkles. One, sometimes it can be measured as the amount of taxes that are actually assessed, meaning like on the books of the IRS, even if they haven't been paid yet, versus what has actually been paid. So you could have a piece of the tax gap that's like Miles Fuller owes the government $5,000, but he hasn't paid yet. But that's like a known, like they just know they need to get the $5,000 out of me, however they're going to do that. So truly, I always think of the tax gap as like, what is the unknown? Like what's the taxes that haven't even been assessed that should be? Sure, I just don't know if technically they always measure it in those terms, but that's one of they have a couple variations, but that's the most important one. Okay. So that's the tax gap. And then when we talk about issues, like unresolved tax issues for how to treat things, there's actually my roadmap for this very much aligns to last June when the IRS finalized regulations for the custodial brokers. In conjunction with those regulations, they issued a notice similar to the one you talked about that came out on New Year's Eve, like an IRS notice. But this IRS notice identified, let's say, 5 or 6 specific types of activity like that you see happening in the ecosystem. That the purpose of the notice was to tell brokers like, hey, if your customers are doing this activity, you don't have to do any reporting. And the reason behind it was like, because we don't know what the right answer for the tax rules are. But those like 5 or 6 things are generally like wrapping and unwrapping. So I got Bitcoin. I want to get it on Ethereum. I got to get some wrapped Bitcoin going. So that's a token, not a coin. And like, are those really the same asset or are they a different asset? So what's the tax treatment of that when I wrap something or unwrap? The other question is when I enter or exit a liquidity pool. You know, if I drop units in there, is that a taxable event? I'm kind of, conceptually, I'm lending my units into the pool. And then later, and there is a long-standing part of the tax code that deals with securities that said if I lend out a security, so some other person could do a short sale or something, that's not a taxable event. However, there's a very specific code section that says that. That code section doesn't apply to crypto. So there's sort of this like, what's the right treatment for lending? And liquidity pools, another one. And so lending and liquidity pools go hand in hand in my mind, although I think the IRS talks about them as distinct things.
Mm-hmm.
And another issue that the IRS has a viewpoint on, the public has a contrary view, or some members of the public, which is when I'm validating. If I'm validating on a network, like running a validation node or participating with a group of people doing a node, particularly on proof of stake consensus mechanism networks, what's the right tax treatment there when I get my reward, like my newly minted reward? We can call them reward tokens. Are they taxable at the moment I get them? Or are they taxable, like not at that point, and maybe not taxable ever until I sell them?
Yeah.
And so that's been subject to some litigation. The IRS thinks they are taxable when you receive them, but it is kind of a little bit of a gray area. So we'll see where the litigation comes out, or that's another area we could see legislation on. You know, Congress could say, this is just the rule, and here you go.
Yeah.
Those are my kind of lists. The other one, similar to wrapping, is bridges, cross-chain bridging that you see, which is wrapping of a different flavor, so to speak. And what's the treatment of those?
Yeah. You're talking about airdrops too, right? Because I've seen the argument around that too. It's like, if you don't sell it right when you get the airdrop and then suddenly it tanks, you're still responsible for
that. Is correct. So right? I think the airdrop one is a good one, where I don't know that there's as much debate about the tax treatment. Like the IRS has been pretty clear that like if you get an airdrop, the moment you get the airdrop, whatever the value was, you're supposed to take in the income. And then you're right, if it tanks, and I haven't seen anyone push back on that, but I agree 100%.
I think just like maybe the problem from like a crypto perspective is like, it's almost incentivizing people to sell when they get airdrops opposed to like holding on to it, because historically I've seen that a lot of these airdrops, they don't typically go up immediately. Maybe they go up long term, but you know what I mean? Like a lot of them, you get the airdrop, it might go down, back up a little bit, and then like tanks over like the next month or two. And then, you know, in that situation, it's like hot potato and you're stuck with it.
Yeah. And that's
a lot of money due.
And so people have it because they're like, wait a minute, I got this income, then it tanked, and then I tried to get rid of it, but my capital loss from the sale of the airdrop at a decreased value doesn't offset the income from a tax calculation standpoint. The other interesting thing about airdrops, because they're generally marketing related events, is they're like gratuitous and they're unilateral. Like you or I as like an address holder, like we don't get to disclaim an airdrop. Like it's just someone can push it to our address.
Yep. That is true.
And we don't even know that it happened. And so that's where you get people that think it's a little bit unfair, that the tax treatment that it's like, I can't, it's like, it's not like someone showing up and putting bars of gold on my doorstep. You know, so they're just dropping this stuff. And if there's some weird value to it, so that's I think that's one that's ripe for some legislative action for Congress to say, these are, you know, the IRS could try to do something, but I don't know if the IRS has the appropriate authority to just sort of say like, hey, even though under the tax law, this should be taxed, we're just going to ignore it because we think it's a better policy stuff should go to Congress. So Congress should say, hey, this is a problem. We should say when it's an airdrop, like, or create some safe harbor way of saying, what if you took the asset into income, but valued it at zero? So not the value. You brought it into your inventory of what your holdings are, but then you didn't have to pay tax until later, much like the staking and whatever that stuff, the validation stuff is, because that could be a nice resolution in a tax statute. Let's do that. We'll talk to someone in Congress and propose that.
We know a guy. We got someone in contact, right? Yeah.
Pose that in there.
Yeah. I think we've covered a lot of ground during this episode, Miles, but I'm curious what would be like your biggest thing that you would want listeners to take away? Like in the near term, what's so important to you that you just wish you could tell everyone that? And then in the long term, what's your outlook for all this? Like, how do you expect it to change and get hopefully better?
Yeah, I think it'll get better. My near-term thing is we're in tax season, so just file.
Please file your taxes.
It'll be okay. File your taxes. I promise. Like, even if it got slightly wrong, the IRS is not going to like haul you away in handcuffs or something. Just file. Do the best you can. Only because it's a good look for the industry that like people are trying to be compliant and stuff in general, and that would ease some of the tension, I think, at the government level. Longer-term outlook, I think we're in a good spot and we're moving in a positive direction. The biggest thing I think, like even in the short to medium term of things I think I can see transpiring on some of the unanswered tax questions that come up, people have questions like, oh, well, I don't know when crypto is a security or commodity. So I like look at it totally a non-tax issue in my mind, at least initially, is like if we can have, and we've heard it from the new administration, some legislation like marketplace framework legislation around when are crypto assets fitting in the buckets of securities or commodities or something else? And then like stable coins, where are they fitting? I think legislation around that, which will do wonders for the non-tax world, like the securities world and the commodities world, and help industry with that area, would be great. But then what you have from that is a nice follow on that there are a lot of provisions in the tax code that already say how securities things are taxed. So if all of a sudden a certain crypto asset is also a security, then you're like, boom, the tax code says security, it's like this. I just follow those rules. I don't need a different set of rules. Mm-hmm. So that's, I think the best like return from the government side would be like, hey, let's figure this out. Then once we get all that in place, we can start to figure out where are the remaining little gaps and try to solve for those.
Mm-hmm. And what about for TaxBit, working with a lot of enterprise businesses? How are things changing, evolving?
I think we continue to grow. We're expanding internationally. I do think as this custodial stuff, as we mentioned, that's coming online this year for the first year, we've assisted for a number of years some brokers out there, that places that are now considered brokers under this rule. We've assisted them with just sort of voluntarily or on their own, like wanting to do 1099 compliance. So now that there's rules in place, we're there to try to help those companies manage that and figure it out. There's more sets of rules to come online in a couple of years. And so we're trying to help enable that for all of them. And also we have a line of business that does financial accounting. And so that's like companies that might have proprietary holdings they need to report financially on for SEC or some accounting based purposes. Mm-hmm. So as we're hearing more about sort of the SEC pulling back a little bit, where people might start to hold more crypto. So we're hoping to help that. And then we do continue to help governments wherever, like educate, so they can understand better how the ecosystem is working, how the technology works, understand the data, and be able to provide them with tools that can help them whenever they need to do an investigation of some sort, whether it's tax or just law enforcement or illicit finance, just so they can work with the data and be able to find the bad people and charge them with crimes and put them in jail or fine them or whatever the right outcome is.
Yeah, no, that makes all sense. Miles, this was super interesting. And I appreciate you coming on today. Thank you so much.
No, thanks for having me. I enjoy it. This is a very interesting topic. I love chatting about it.
For sure. Go file your taxes, everyone.
Yes, exactly. Get out there, get them filed, talk to a tax professional, use software, something, but get it done.
There we go. Miles, thanks again.
Thanks a lot.